Welcome. Let's record some financial transactions, business transactions, and at the same time, let's see how balance sheet, trial balance, balance sheet, and income statements are created. So let's say I have here on a piece of paper written 9 transactions. First transaction is 3,000 initial investment from the business owner. Obviously, that will be credited $3,000 to the paid in capital account, and the money has come into the business. Whenever money comes in, on the left hand side, which is what asset side, it is green. Money came in, it is green, happy, business is happy, money has come in. Money goes out, we write it in red. And whenever money is received on this side, which is the who side, either the banks or the owner of the business, we when they give money to the business, it's written as a credit in the green cells in this my example. So the next transaction is same business borrowed $2,000 from the bank. Obviously $2,000 came into the business, and it's going to be credited to the notes payable, which is usually loans. In this example, I'm writing it here on the notes payable. Usually people may have account called banks or bank's name, TD Bank or whatever bank, but then in this case it's a generic example, so I wrote notes payable. So you see how it is balancing. $5,000 asset I have, which is in cash, $2,000 liability, and owner's equity is $3,000, meaning from this 5,000 the $2,000 are owned by the bank and $3,000 are owned by the business owner. Now let's say business buys a laptop of $2,500. Obviously $2,500 will go out of the business, so which is a credit. On the what side, see, debit and credits have no meanings in reality. If you are writing towards the what side, which is this side, debit means money came in, credit means money went out. And on the who side, whenever owner gives money to the business, it's money in, which is credit, exactly opposite. And whenever banks give money to the business, it's credit, written as credit, and when money is paid back to the bank, it's written as debit. So in and out, exactly opposite on the other side of the equation. So you see this $2,500, obviously laptop is an asset, so my assets, physical assets, have grown. Now I have $2,500 laptop as an asset, and cash is $2,500. Obviously equation is going to balance, which you see in front of you. Now company has successfully won some business, and they got some business. Basically $3,500 are sent as an invoice for the software consulting. Obviously accounts receivable, right? $3,500 is the money to be received, and it's revenue, so we will write $3,500 as revenue. You can see my trial balance is $8,500 both sides, and revenue is $3,500 in this example. So if I sum it up, 8,500 is who side, and what side, which is asset, is $8,500. Now $2,000 paid in salary. Obviously someone did job for me, the website development or whatever it was, on behalf of the company, so that money went out as a salary. So it went from the cash account, $2,000, and in the expenses we booked $2,000 as debit. So you see again the equation matches perfectly, 8,500, and the other portions of the equation also you can see. Another transaction is $500 utility bill is received. See, there are 3 kinds of transactions, right? One is cash upfront. One hand you take things and you pay upfront. The other is you pay in advance, like prepaid cell phone or something. And the third method is you receive an invoice and you pay after 30-40 days. So this is the third kind of transaction, which is we used electricity and we received a bill. $500 is accounts payable, so I will credit $500, which is my liability, and $500 is expense, which is being recorded here, $500. So you see now again my equation matches 9,000 on the both side on trial balance, and here my assets are $6,500, and summation of these two, which is this and this, is also $6,500. Now $2,000 invoice again is sent for another consulting business, so which is accounts receivable. Second invoice, second client, $2,000, and revenue is obviously $2,000 to be received. It has not been received yet. So these are the two transactions we made. The third transaction is going to be, now the partial payment came. For this invoice, $3,500. The client has sent $2,800 only. So $2,800, 2,800 cash. So again, my equation, you see trial balance 11,000 on both sides, and the equation also matches 8,500. 6,000 plus 2,500 is 8,000. Okay, after $2,800 partial payment, another payment is made to the bank. $1,500 is paid back to the bank. So I will remove 1,500, meaning credit 1,500 from the cash account, and it's debited to the loan account, which is notes payable 1,500. So you see now my trial balance 9,500. My balance sheet is assets are $7,000, liabilities of $1,000, and owner's equity is $6,000. My revenue is $5,500. Expenses are $2,500. So everything matches here. This was a demonstration how the entries are made in the T accounts. These are called T accounts, and how they will reflect on a trial balance, balance sheet, and income statement. Thank you so much.